Good day everyone, hope you guys are doing well. Happy Chinese New Year's to my fellow friends as well. Today's lesson will be on put options and very specifically buying of put options. If you recall in my earlier videos I mentioned that there are 4 scenarios to trade options. We can buy a call, buy a put, sell a call or sell a put. Today's focus will be on buying. Bear this in mind throughout the lesson to avoid confusion. We are always viewing from the lens of a put buyer. Now that we are aligned on this, let's get started. So some disclaimer in a nutshell, this is not day trading or forex. Moreover, investing or trading are not risk-free instruments, as with anything we do in life. This is strictly for education purposes only. Content today as shown, I will go through what is a put option, how to get around understanding how it works rather than just merely memorizing it, the advantages and disadvantages, and how I use them to profit from the markets. And at the end, there will be a bonus session. So what is a put option? And what does it mean to be a buyer of a put option? If you buy a put option, you have the right to sell 100 shares of a stock at a fixed price upon expiration. This pre-agreed price is also known as what we call the strike price. For this right to control and lock in the selling price for a set period of time, you have to pay a fee. And this fee is what we also call as the premium. Remember, each option contract is always measured in denominations of 100. The next thing you need to know is when you buy a put option, you are bearish. Being bearish means you expect the stock to drop lower than the price it is currently trading at. Now, to help you understand why buying put option means that you are bearish, let me go through an example. Let's talk around one of the famous cruise companies, Royal Caribbean Cruises, ticker symbol RCL. Say the stock is trading at about $100 now, and you're bearish and think this stock will go down in the next 2 months. Therefore, you bought a put option with a strike price of $80 at a premium of 3.0, aka $300, with 2 months to expiration. The premiums you paid is $300 because each option contract is 100 shares. Therefore, $3 multiplied by 100 shares is $300 of premiums. Now, what this means is you now have the right to sell 100 shares of RCL at $80 at any one point within these 2 months. If you do so, your break-even cost of selling away each share is $77, right? Because you paid $3 of additional premium for each share. Now, let's go through the example. If RCL drops down below $70, to say by the end of the 2 months, you will make a nice profit. If you refer to the slide, the explanation goes like this. Even though RCL is trading, at $70 now for the market, you can have the right to sell it to someone at $80, therefore making a profit of $10 per share. Multiplied by 100 shares, that gives you $1,000 of profit. For this $1,000 profit, initially you also paid a $300 premium, therefore your total profit for that each contract is $700 US. Now, if the stock goes to zero, your max profits will be $80 multiplied by 100 shares, because even though the stock goes down to zero, you still have the right to sell it at $80, and therefore you will back a $8,000 profit. So $8,000 profit minus away your initial premium of $300. If the stock goes to zero, you will make a total of $7,700 US per contract. Please listen up. This is the reason why when you buy a put option, you are bearish. If the stock price goes lower than your strike price, you can sell the stock at a price higher than the current market price the stock is currently trading at. Therefore, you profit from buying a put when the stock is performing in a bearish manner, because regardless of how low the stock price goes, you always have the right to sell it away at a fixed price, even if the stock goes to $0. Moving on to the next session, I will be talking around the advantages and disadvantages of buying put options. The points here are largely similar to buying call options, but the context is slightly different. First point, recall the previous RCL example, we paid a $300 premium for the right to sell 100 shares of RCL at $80, right? So the beauty of buying a put option is if the stock goes up to infinity, yeah, your maximum loss is only the premium which you paid. Let's talk around the case whereby you decided to short the stock, right? So shorting means you're bearish and essentially you sell high and buy low. If you shorted 100 RCL shares, and RCL, let's say, goes to $150, your loss will be $5,000. If RCL goes to $200, your loss is $10,000 and so on. So the higher RCL goes, the higher your losses if you're shorting the shares. For the case of buying put options, your max risk is only $300 to participate in the same bearish sentiment of the underlying stock. So let's say RCL goes up to $1,000, right? Your max loss will always still be $300 for buying a put option, and that's very good for managing your own risk. Which brings me to my second point. As a put buyer, you need less capital upfront as well to participate in a trade which might yield potentially bigger returns. If you short a stock outright, you usually require a much larger option buying power. So let's say for the same RCL, you need to short it, right? You need a $80 multiplied by 100 shares, which is $8,000 to short. Right? And the higher the stock prices go, the more your loss. Your losses are unlimited. But for a put option, you only need $300 to participate in this trade. The final point on the advantages is the fact that you can choose a reasonable time duration for the stock price to head in the direction you predict. This becomes really helpful when you pair it up with other analysis such as your RSI, MACD, candlesticks, price actions, standard deviation channels, Greeks, Fibonacci, etc. Right? But these are a little bit more high level, but for a start, it's just good to know that you have a nice time duration to increase your probability of making a nice profit. Now let's talk about the disadvantages. So similar to buying a call, when buying a put option, you have to pay an upfront premium, right? Paying a premium is not always bad because sometimes you need to give before you receive. Moreover, when you buy puts, your risk is limited. And always remember that you can buy at a lower price and sell it back to the market at a higher price if the stock price drops down, right? That's something a lot of people don't know, and it's good that you know. You do have to hold to expiry, right? You can always close it halfway through. As long as you stick to strict proper risk management procedures, buying puts are actually perfectly safe. The next point, when you buy puts, or even if you buy options in general, you only profit from one direction, and in this case, you profit when the stock price goes down. So that's one of the disadvantages that you need to take note of. The last one is also your profit potential is time bounded, which means that any favorable stock price movement after contract expiry will not materialize. So using the same RCL example, say you bought a $80 put which expires on 31st December, and if the stock price goes to $80 on 31st December but falls to $50 on, let's say, on the 1st of January the next year, you will not have this right to sell it at $80 anymore. Therefore, timing is an important factor to bear in mind as well when you buy options in general. If you have watched my buy call option 101 video, I strongly encourage you to as well. You realize that there are many similarities in traits and characteristics of buying a call and buying a put. And the only main difference is that when you buy a call, you have the right to buy the share, and when you buy a put, you have the right to sell the share. The next section will be on how I profit from buy puts. So I like to buy put options with reasonable time duration. I buy the put at a lower price, and once the stock drops down, this same buy put will be worth more, and I will just close it prematurely before its expiration and make the difference. If you see this slide where I share one of my most recent trade signals, I bought a put for APPS ticker symbol. I paid $35 in premium for one contract each, and I close it at $55, which means that I make a delta of $20 US per contract. I can't remember how many contracts I did. Maybe I did 4 or 5 or 6 contracts because the total risk is so low. But nevertheless, even though it's only $100 to $200 USD, profit is still a very nice win for me. I think at one point it went up to over $140 per contract. So those who closed the trade just, a couple of minutes later, enjoyed a lot more profits. Okay, so now let's jump to a quick storyline to help you remember better on buying a put option. So let's say it's the start of March 2020, COVID-19 happened and the stock market starts to crash. By mid-March, each ticket for entry to a cruise costs maybe $120. You bought a put option, which gives you the right to enter the cruise at $80 regardless of what the future prices of cruise tickets might be. It has a 6-month validity and you paid a $200 premium for that. Now fast forward to June, if the prices of ticket continue to fall to say $100, right now your contract might be worth $400, right? Because the likelihood of cruise tickets depreciating is higher and you still have 3 more months to go. So what you can do is you can choose to sell this put option contract back to the market and make a $200 difference. Therefore, you make $200 USD per contract and you exit the trade. Or you can have patience and hold all the way till August expiry if you foresee that the cruise industry will, it's not going to go anywhere or recover anytime. Sorry, it's not going to recover anytime soon. So say by August, there are still travel bans, safe distancing measures, no crowding or mingling in enclosed spaces. Basically, the cruise industry remains badly affected. Now, each ticket is only worth $50. However, you still have the right to sell the tickets to someone at $80, right? They have to buy it from you. Since each option contract is 100 shares, each contract will make you a total of $3,000. Because $80 minus $50 is $30, multiplied by 100 shares, that gives you $3,000 US. You deduct away the initial premium you paid of $200, you make a total net profit of $2,800 US. So that is the concept of buying put options, and generally put option buyers are bearish about the stock and expect it to eventually go down. Okay, sweet. So now the final part of this video, I will be navigating the Thinkorswim platform to show you some simple ways to execute a trade and what are some of the basic things to look out for when you are looking to buy a put option. So talk to you soon again. To navigate the Thinkorswim platform to purchase a buy put, firstly you need to go to your trade tab, right? And then you type in the ticker symbol which you want to analyze or enter the trade. Therefore, for this case, let's say we use RCL, and let's say we want to look at a decent time frame of, let's say, 20 days, right? Or even 34 days. Firstly, what you want to do is change the view to see all the strikes. Yeah, I think in default, you might be only seeing a few. So click all so that you can see all the strike prices here. And the put option option chain is on the right side. If you see my mouse here, that's where you can differentiate between a call and a put. So calls are on the left and puts are on the right. And when you want to buy a put option, you always look at the ask price. So let's say RCL is at $67 right now, and I think it's going to go down even further. For example, over the next 34 days, I can buy a $60 strike price or a $65 strike price for a $230 or $400 premium respectively. Yeah, so if you realize that the more out of the money your strike price is, the cheaper the premiums. So out of the money means that, in this case, your strike price is lower than your current stock price. So as you can see, the lower the strike price, yeah, the cheaper the put option premiums. And why is that so? And the reason is because the probability of the stock going down to below $60 is lower than the fact that it will go down below $55. Therefore, when you buy a $55 put, yeah, you pay a lot less premium because the likelihood of it happening is lesser. So logically, that's one way you can remember. The more out of the money the buy put option, the cheaper the premiums. You can see that the price difference between the 55 and the $60 put is about $800, right? 228 minus 1.2 will give you about 1.08, about $108. So to execute a trade, you can just head on to ask, and let's say you go for the $60 put, left click, and then you can similarly choose the mid price for the best price. If you can't remember, just think about it this way, right? So now you can buy a put at $224 or $228. Which one would you want to choose? Obviously, you want to choose the price that's lower, right? You want to save that $4 USD. So always choose the mid price. Set the number of contracts to the amount you want. I think your default is 10 if you haven't reset it yet. Choose 1 or 2 or 3 depending on the risk management that you have, and then just click confirm and send, and you're done. I hope you guys benefited from this video, and stay tuned for the next one where I'll be sharing more on selling calls and selling puts. Thank you.